Today's market call is presented by Robinhood. Take charge of your trades with Robinhood's powerful new free desktop trading platform, Robinhood Legend. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood financial fee schedule for more information. Well, if it's Wednesday, it's Butters, bitch, but it ain't Wednesday. It's
Dude, you just did that to crack yourself up. Let's be really clear about that.
I bet you Bill is laughing right
Bill
now.
Is laughing. Bill is laughing.
It's Tuesday, July 29th. It's 11:01 a.m. It's Guy Adami. It's Dan Nathan. It is Market Call. Tomorrow will, in fact, be Wednesday, unless the sun explodes, and then we don't have to do this show either. But I don't think that's going to happen. How are you, Dan?
Well, by the way, the sun is more likely to fizzle out than explode, I think. I just think
Is that how that works?
If you just look at sci-fi movies, there's a new, all right, we've done this before. Are you Ryan Gosling or Ryan Reynolds? And mine is
I'm a Ryan Reynolds. I'm in the Reynolds camp.
Really? Oh, yeah. I'm hardcore. I'm waving in Gosling. He's my Ryan. Okay, I just want to be really clear about that. But maybe Jacob can find this. There is a movie coming out, I think, on Netflix next year. It's Gosling. He's being sent to the sun because it's dying out, man. And you've seen this one before. We know this sci-fi trick.
So they send him to the sun to
It's called
save
Hail
the
Mary.
sun?
It's called the Hail Mary Project.
I see this.
Go watch this trailer. We'll put it in the show notes. It's my Ryan. He's gonna light it up. So there you go. All right.
So and the other Ryan, hold on, before I apologize.
Yeah.
The other Ryan's married to Scarlett Johansson. Is that correct?
No, he's married to Blake Lively.
Who's married? Oh, the guy from Saturday.
Who looks like a Ryan, by the way.
He looks like a Ryan.
He looks like a Ryan, but he's from Staten Island. All right.
Sorry about that. Okay.
We went through it yesterday. We got a lot going on, but tomorrow we have a very special guest, Guy Adami. Her name is Katie Stockton. You might know her from Fairlead Strategies. You might also know her from CNBC's Fast Money and many other programs she does. She's a chartist, a technician. She's going to be joining us with some really good stuff. So we're excited.
Which is great because she's up there in the Parthenon or Pantheon or whatever of technicians. Her work is extraordinary, and we're lucky that she's going to join us. And we look forward to having her on maybe a couple times a month going forward. So obviously tune in for that. But today, tune in for a bunch of different things, not least of which the note that came out of, we just like to call him Rosie, but that, of course, is David Rosenberg. And I think he's saying a lot of the same type of things that we've been saying. He just does it in a more, for me at least, in terms of comparison to me, a far more eloquent way. So here we are, Dan.
Yeah. So Rosie, and we quote him a lot. He's been a great friend of the show. You and I have known him for a long time. And, he's one of those guys, and, maybe it's like me, you get painted as this, you're a perma bear, this, that, whatever. I just think there's a lot of nuance in that. We've been talking about that for a while. That's not being defensive, so I've been reading Rosie's stuff. I've been talking to him, for 20 years. And I think for a guy like him who likes to pick apart some of the, some of the holes, at least in the universal bull case, and he's doing that right here in his mornings with Dave. And I get this. It's the first thing I read every morning, or one of the first things. So I do think it's interesting, Guy, when you talk about, we haven't heard this a lot, but 60% of the market gain has been in multiple expansion.
Yes. And you're right. We don't probably talk about it enough, but we have pointed out that so much of this move higher is just people willing to pay more for a dollar's worth of earnings. That is multiple expansion. Anyway, I'm sorry, please.
No, I mean, my point is, yes, we should talk about it more. Yes, too few people talk about it. They don't care about valuation. If you don't care about, an S&P that normally trades at about 19.5 times, that's trading at 23, 24, that's kind of trailing, and forward about 22.5. Well, sooner or later, you're setting yourself up for a little bit of a speed bump. And again, you might say, listen, I can't figure out the reasons why the market might go down. And at this point, Guy, and you and I, I've been calling it from 5,900. Here we are at 6,400. I thought there would be some sort of retracement back to a moving average, back to something, but the market hasn't cared. So I think this is an important data point. The next one, Guy, and you probably got this email from our friend Doug Tass. Okay. So he obviously writes for thestreetpro.com, but Seabreeze is his fund. And this is just kind of simple stuff, and I'll let you speak to it a little bit. But his point is it's not different this time. If you go back to 2000, you go back to 2007, those are the two prior times where the S&P got cut in half. If you look at the top 10 names by market cap, it wasn't, like all these crazy, it wasn't pets.com. It wasn't, all this sort of stuff. It were real names, real economy names. Just speak to that a little bit, Guy.
It's not, again, the importance of this is to point out the market's not being dragged up by, to your point, meme stocks or flash in the pan stocks. It's been driven up by the same types of names that historically have done the heavy lifting. '07, you can read it right there. We all know these names. There's not one name on that list that our viewership has not heard of. In 2000, the same thing. I mean, if you want to sort of nitpick and look at number 5, I mean, that is maybe the outlier there, but we all know the same things in America Online at number 10. But the point is, all household names that did the heavy lift, that seemed impervious. The market is different this time. And as Doug points out, it's never different. It's always dragged up by 10, 15 or so names. Now, the problem is, of course, when things turn, the names that did the heavy lift, I mean, they will, just as it works to the upside, it works equally to the downside. And typically things go down a lot faster. But you look at this and you realize that as much as it feels different, the only thing different really are the numbers next to the names in terms of market cap.
Yeah, so add a couple zeros there. All right, so which is truly astounding. I want to rip through some tariff stuff. Last night on Fast Money Guy, we had I think a healthy conversation. It was interesting to hear from Tim Seymour, who has been very optimistic about the markets. He's been very optimistic about the fact that I think our markets and maybe even the economy to some degree was going to be able to take a lot of this kind of trade tariff stuff, in line here. I think he said slightly cautious tone last night, which I thought was kind of interesting because just as these numbers are starting to come out with some of these deals, there's two numbers, right? It's what is the base tariff rate, what is the investment that is coming with that in the US. We've kind of picked through some of that sort of stuff where it seems to be pie in the sky, at least the Japanese investment of $500 billion. This is the EU talking about 750 billion, 250 billion of that was going to be energy, and a lot of that they're already buying, and the other stuff is whatever. So this is interesting to me, Guy, when you think about where this is coming from, where is the sentiment coming from, the complacency. And here's they're quoting an analyst here. Clients we talk to are certainly jaded when it comes to the tariff topic, and we sympathize the evolution of tariffs can still create pressure and opportunity. Let's talk about the pressure. Between the lines, Morgan Stanley notes that reasons behind their call. So they're saying, like, just don't be too complacent right here. The full economic impact of existing tariffs is still unknown. That's the conversation that we had last night. Upcoming trade decisions involving major partners like China, Canada, Mexico have broader implications to the U.S. Even if tariffs don't weigh on growth, which is nearly impossible, they may weigh on specific sectors of the stock market. These effects may not be priced in. Next one really quickly, Guy. Bloomberg, and you can parse through this. Look at this. EU, 20%, but look at Mexico, look at Canada, look at China. Those are all infinitely more when you combine them together.
All right, so let's just try to figure this out for a second. The point you've been making is, despite the fact that the tariff number itself is lower than the most feared number, it's still a multiple of what we've been looking at prior to. So there are some ramifications based on that. And the optimist will say it's not as bad as feared. The pragmatist will say, yeah, it's not as bad as feared, but it's still going to have an impact. And the fact that the market continues to sort of rally, it sold off on the worst case scenario. It started to rally on sort of the pull back a little bit, the push out a little bit, and it's continuing to rally on some sort of deal structure, but not taking into consideration deal structures as currently constituted have impact. And they have impact whether it's on the companies that are trying to eat the tariffs or the companies that are trying to pass on to the consumers who will subsequently eat the tariffs. There is no free lunch here, I think is your point. And almost by definition, despite the fact that these tariffs are lower than feared, are still higher than the existing status quo. And the fact that the market just goes up every day on the back of this, to me, is a little confusing, in a word. And I don't think the full ramifications in terms of just the math Forget about the politics, forget about the rhetoric, forget about the noise. Just the math have not been baked in. Did I do okay with that?
That was amazing. I mean, listen, I don't think we're infusing any politics into this, right?
No,
Like
no, I'm
we're
not
looking at
suggesting. No, I'm not saying. But you
yeah,
understand just the
yeah.
math of the whole thing.
Well, we're looking at through the lens first of the markets, what the markets are willing, and that's investors, what they're willing to discount on this front, right? That's the kind of whole, I think, theme of what we've just discussed for the last few minutes. And then really the economic impacts are the things that, and this is what the Morgan Stanley strategist is suggesting, we just don't know, which brings me to our friend Dan Greenhouse of
Didn't we
Solace
just have him on the podcast?
We did have him on the
Yeah, I
podcast.
know.
That would be the
I know this.
Reversal podcast that dropped on Friday. It was actually a great conversation.
It was great.
And
you know what? Hold on. I'm sorry.
No, go.
First of all, I really enjoyed Dan. We've probably had him on 4 or 5 times. I think maybe a little bit more. You understand my point. We enjoy him as a guest. I love his work, and I love I love the fact that he's willing to engage and push back. It's great. The one biggest takeaway from me was the fact that Led Zeppelin is his #1 band. I love that. I love that.
There was not, he didn't skip a beat when you asked.
It's like Led Zeppelin. I'm like, my God.
Dang. He's a really, he was trained under the Peter Bookvar school of economics, and he's also a huge music fan, just like our main man Peter. But this was interesting, guy, because Dan was one of those guys. He's definitely a glass half full guy. Okay, and so
right to be.
And he has been. And so he put this tweet out, and we were kind of getting the sense of this from him on the podcast. But he's basically saying, I've remarked investors appear to be a little complacent about tariff risk because they haven't hit in the way some incorrectly forecast, not as quickly, and some are assuming they might hit at all. And so he's saying that the point is the difference between tariff delays, inventory build, company mitigation efforts, and goods already over on the water on the way. Some percentage of the tariff impact was going to take time to be felt. And that's something we've been talking about. It's been a back half of the year. But here's the thing, and we can zoom in on this and we'll put this in the show notes. He brings receipts, guy. He's basically giving direct quotes, and Peter Bookvar does this really well too, of what these companies are saying about tariff impact. So I just wanted to kind of highlight that because, we said, Tim, we're talking about Dan. These are some folks, the strategists at Morgan Stanley, who are now start thinking about this in a different way as we've started to be able to put, to your point, some math parameterizing some of this stuff.
It gets granular. And now you start to see in terms of company by company, sector by sector, you can start to figure out some of these companies are going to eat it. Other these companies are going to try to pass it on. If the companies eat it, it impacts margins. If they pass it on, it impacts the consumer. You tell me how there's no impact on this. Of course, by definition, there's an impact. And, I understand the administrations want to talk about the trillions of dollars that are coming into the word coffers, which I know what the word means, but I don't really fully understand what they're trying to say, but it sounds good. The reality of the situation is the lion's share of all this is either being eaten by companies or eating by the consumer. And if you just think about it, forget the politics. This is not directed at you. It's just in a general comment. Yeah. If you extract the politics of this, somebody is paying for it. And if somebody's paying for it, by definition, that means there has to be a drag, a headwind, or whatever on profits, margins, EPS, whatever you want, a number you want to throw out.
All right. So this is a good segue, guy. What is the impact here? So Stephen put together a little.
That's Stephen Rafis, by the way, who was in the running for the Tier Wharton. Can you pronounce that for me?
Wharton Award.
By the way, I'm sorry. I apologize again, but it's Wednesday, so we have Butters coming up. So.
We have Butters tomorrow.
And Stephen, I don't know if you can chime in on this or not. I don't know if he has a microphone. Does everybody that plays Division I lacrosse get nominated for that friggin' award? When I look at the list, it's like 50 people are nominated. I mean, is that fair or no?
It's not that fair. I mean, like Stephen was one of a few. You know what I mean?
No, it's not a few. A few is 3.
Yeah.
So it's a laundry list of people. Now, listen, I wasn't nominated. I'm not casting aspersions. My point is, beginning of each season, I see, such and such is up for, and then you start to read the list. It takes you 20 minutes to finish it. Anyway, back to you. What did Stephen put together?
He put together a list of post-earnings movers. These are companies that reported last night or this morning. Now, Guy, I know you're paying attention, but
cheapest thing you can do.
Yeah, this is sticking out like a sore thumb here in this earnings season out. Let's take financials out, which we got the banks 2 weeks ago. Okay. So we talked about yesterday. We talked about Texas Instruments, IBM, ASML, Netflix, Intel. I'm missing a couple. Oh, there was some away from tech, Lockheed Martin. There was a handful. Look at this today. Let's put Spotify in the Netflix bucket. Spotify actually, they swung to a quarterly loss, and
which I don't understand. I don't know what happened.
Part of it was currency. Part of it was like some sort of because the stock-based compensation, the stock rallied so much in the quarter and taxes, whatever. Okay, Novo Nordisk, we talked about yesterday. Absolute calamity, shit show. All of a sudden, people aren't taking Wegovy anymore. I still am. Okay, that stock is down 21%. UPS, this is one you flagged yesterday. You talked about it on Fast Money. This was going to be a very interesting indicator about all those things that we just talked about, right? UNH, maybe that's stock specific. Whirlpool, definitely tariff related. PayPal maybe got ahead of itself as far as some of the stuff. That's, let's just say, Royal Caribbean guy. I know that you like to take a cruise or two every year.
First of all, again, I apologize, but you brought T. Wharton. Oh, I brought that up. You brought Steven up, and then so I'm not going on a cruise. You have to come up with some astronomical number to get me on one of those cruises. Apparently, the Netflix did one of these. I think the name of it, and Jacob probably has. They call it like the poop cruise or something, where some ship, and I don't want to say, I don't know whose liner it was, but they're all basically the same, was out there. Somehow they lost power in the middle of some body of water, completely lost power to the point where nothing worked. So they're out there adrift for 4 days. They couldn't use bathrooms. They handed people bags to shit in. I mean, can you imagine? And then things started to overflow. And then it's like Lord of the Flies shit going on out there. So everybody's gets on the boat and they're all sort of happy, we're going to have so much fun. You see how we are at the basically right on the tip of a pin in terms of being able to drift into anarchy, and it happened on that boat. So ain't no way you're getting G-Swizz on one of those. It's just not happening.
By the way, and people fall off those things all the time, which is insane. Like there's a lot of crazy shit that goes on cruise ships. I've never been on one. I will never go on one.
Hold on. Bill texted me. Let's see what Bill has to say.
But by the way, we have a correction in our chat, guy. That Jacob says that the sun is always exploding. Isn't that kind of the point? And I was like, okay,
constantly exploding. Okay, all right. Everybody's a comedian. I mean, explodes like, or maybe it doesn't. Maybe it implodes. I don't know what I'm not.
There's one guy. Everyone's a comedian except one guy.
Bill
on our team, but whatever. All right, so
sorry. What we were talking about. No. So let's go back to the list. No, sir, I want to sort of go through this. Spotify, I don't know what happened there, but the stock's been a monster. So, the fact that you said stock-based comp and hit, okay, fine, I'll give them a pass. Novo Nordisk's been an absolute unmitigated disaster. That is company specific. UPS, just really quick, put up a UPS chart over the last 5 years and just think about what the stock market has done over the last 5 years. Just think about what e-commerce has done. And then you say, if you just thought about this, if you weren't in the markets every day and you say, well, then a company like UPS has to be killing it. No, actually, it's been getting, and it's UPS specific. I mean, this stock is now more than cut in half from its all-time high, which is mostly UPS's fault. But there's some underlying concerns just economically as well. Let's continue to go down the list because I think this is important. UNH, we all know about UNH, clearly a UNH problem, but sort of makes its way into the rest of the group as well. Tremendous headwinds there. Whirlpool, to me, is the most interesting and the most important one because you said it. This is a company that is trying to figure out how to deal with tariffs and a slowing consumer. And it's manifesting itself in a name like Whirlpool down 10% today. You look at this, the all-time high, I think, in the stock, Dan, was, I want to say, $250 or so in the spring of 2021. Again, more than cut in half since then. So you're saying, guys, you're cherry picking to a point, but each one of these is a story that I think is worth paying attention to.
By the way, not cherry picking. I mean, I'm literally looking at my fact set screen, my main board with stocks that are up a lot or down a lot after earnings. And that's it. And you tell me if I'm missing anything. Put it in the chat here, people. And, the last thing I'll say about Whirlpool, guys, it's also housing related, right? So we've been talking about the stuck housing market. And then the flip side is let's throw up the SoFi on here because, listen, like here's a story that has been unloved in the fintech space. I don't know why I'd call it a fintech if I'm, maybe if there's a lot of tech there, no doubt about it. But my point is like this is a lending platform. They have a lot of exposure to consumer. We heard from the big banks that the consumer's doing just fine, that they're not worried about write-offs and this and whatever. Obviously, SoFi, based on their results, are seeing a lot of the same stuff. So, all good on them. But we're seeing, a lot of bad behavior after earnings. I want to pull up Boeing for 1 second, guy, because this is one I know that you've been very bullish of. Okay. I think that you've actually into this, what you were saying is a potential double top here a little bit, right? Or let's just pull up the Boeing chart for a second. I mean, go out like 5 years too, if you want to do this. Like you see where this thing is trading. Well, it's not there yet, but you get my point. It's been on this runaway breakout. Now let's go back to 1 year for a second. Good quarter, good results, good commentary, all that sort of stuff. Stock opens up. Let's do a day chart here or a 2-day chart, and it sells off. Well, where the hell is the stock going to go? You know what I mean?
Yeah.
We're going to talk about some names into this week, and we're going to dig a little deeper here. But like that sort of reversal, who is the incremental buyer of stocks here?
Okay, so let's just break down Boeing for a second. Today's an important day. It typically trades about 8 million shares a day. You have volume. I'm sure it's surpassed that already. So it's probably on pace to trade 3 or 4 times normal volume, if I am not mistaken. Number one. Number two, I thought, now it looks incorrectly, but I thought there's a very good chance that the stock could get back to, I want to say 265 or so. And that was the high in December of 2023. Where did we get today? About 243. So not that close, but you understand what I was looking at. If in fact we trade and continue to trade the way we're trading today and have one of these big reversals on volume, you got to watch out. And you drew that uptrend line. That's in jeopardy as well. So we've had it right. Today is a day, though, it's worth paying attention to without question, because today could be the day that all the good work of the last 3 or 4 months sort of starts to get a little bit derailed. Worth watching.
Yeah, no doubt. We're going to hit a couple names that are reporting in just a few minutes. We have a couple trade ideas too, and one that I think is really important into earnings season. We're going to talk about that as it relates to Apple. It's a collar trade. I'm going to start in a few minutes here, taking the legend for a ride here, guy. That would be the Robin Hood legend here. But I want to, and we also have a trade idea that I'm going to maybe work through with you as we were kind of talking through this. So, I've been very much in the camp as it relates to NVIDIA and their GPUs and their access to the Chinese markets, or the Chinese markets access to them. I have a very kind of staunch view. Jensen Huang, the CEO of NVIDIA, and you and I have been talking about this for months in our podcast. He's been making the case that the Chinese should have access to our nearly best technology, because if not, they will innovate in and around it. Then they will have the ability to kind of push their technology around the world and yada, yada. I disagree with that. I know that is the Silicon Valley take on this, but I also believe that this technology, and you and I were going over email. I sent you something this morning, an FT article. We've been going back and forth on it. We've been talking about it. We have different guests on it. I really feel like, personally, if this is an American first administration, if we are going to all these extents to reorient global trade, we are throwing tariffs on our, some of our biggest, allies in an effort to kind of reorient things around some of our biggest adversaries, just laying down and letting the Chinese have this technology, which will, no doubt about it, ultimately find its way into their defense apparatus and a whole host of other things, but also will let their companies better compete with ours, especially globally. So I disagree with this, but this has been part of a strategy with the Trump administration, with Jensen Huang, and how they're dealing with China.
Yeah, I think it's absolutely fair to disagree. I mean, dialogue and debate is extraordinarily healthy. Now, the other side of the coin is, and again, I know you know this, but the flip side is this is a watered down version. Technology moves at light speed, and what we're providing them is sort of first gen stuff, and we're in third or fourth gen stuff. And it's not just linear, it's exponential in terms of the growth with these chips. So by giving them these chips, giving them access to it, We will therefore thwart innovation in China. And although they'll have access to it, what we're doing is mitigating and holding down any innovation there. And if this can be a bargaining chip in a bigger US-China trade deal, then so be it. That's sort of the administration bull case. And I think that's the case that the NVIDIA CEO is making. And it clearly it didn't fall on deaf ears. It fell on ears that were willing to listen. Now, the next point is that what you just pulled up should have been a very bullish article, a very bullish data point for the stock. And listen, made a new all-time high today at 179 and change. But look at the price action now over the last hour or so. We've reversed lower. We have seen days like this before in NVIDIA, and I'll bring you back to January. We made an all-time high at the time of about 153 and change, reversed lower, closed on the lows of the day, and then subsequently cascaded lower into April. And all I'm saying is, I'm not suggesting that today is that day, but today has all the earmarks of that type of day.
Yeah, and just one last point. I totally get what you were saying about from the administration standpoint. And again, this is not political. This is just literally kind of trying to play forward the thought process of the trade war and who we're trying to ultimately kind of, I don't know, abate, or just kind of, match force with force as it relates to manufacturing for our need for, tariff rates, to access to markets, to access to technology and the like. And so my only point is that Huawei is a national champion of China. Okay. They are not going to stop innovating or trying to innovate, no matter how much access that companies there that they'd like to sell to in China are going to get to these NVIDIA chips. That is the only way forward for them. And they have the backing of their government. The way our government had the backing of our US companies by the CHIPS Act and by putting export controls in, right? Like towards China. So again, they will continue to innovate just because they have access to these chips, here nor there. All right, let's talk about NVIDIA for a second. Let me drive on the legend here for a second. So when I'm looking at this, and I'm glad we kind of, hold on, I have to do one thing here. I have to go share my screen. Thank you, Jacob. Share screen.
We should take it. What do they call it when you break down the fourth wall?
Yeah, we just broke it down. Okay. I'm sharing. Okay. There, look at that. Okay. Let's just go to the chart for a second. Here's NVIDIA here, guy. And I have an RSA on the look at how long this thing has been overbought on the 14-day RSI. Okay. Now let's just go to a 1 day here, just so we can see what just happened, a leg lower. Your point is this is a 1 week. Here's a 1 month. Okay. Here's a 3 month. Here's a year to date. Okay. You got this, right? And so I think a retracement back to that 154 level, guy, the breakout level, makes a lot of sense. You see that rising 200-day moving average. It's basically 120. Where is it? 120 or 134 or something like that. Okay. So let's look at the options chain. Now, these guys don't report until late August, but this week, Amazon, Microsoft, Meta, 3 of their biggest clients, okay, are reporting earnings. We know that Google reported last week, raised their CapEx from 75 billion to 85 billion. Now, listen, that incremental 10 billion is not just going to NVIDIA. There's a whole host of other things, right? But I kind of believe that NVIDIA could be in a tough spot right here if they don't have meaningful CapEx increases. If one of the stories early in the week that we highlighted is that Taiwan Semi, they might get an order for 300,000 of the H20s. They are not tooled to make them right now. They stopped down on a lot of their machinery and what they decided to start building. So to turn that back on is not going to be something that easy, okay? So if I'm looking at this, I'm looking at the options chain. We just kind of outlined some of those levels here. I'm looking at the August expiration. That's August 15th. You can see where I am right here. The stock's at 175.70. The one, let's go to, that's the wrong August. This is why, guys, you have to be so careful with this thing. All right.
Double check. It's like that old carpenter thing. Measure twice, cut once.
Yeah. So if I told you, guy, with a stock at 175.81, the August 15th expiration, so it's about 2.5 weeks or something like that. The 175 puts are 445. The 170 puts are like 268. So if you paid, let's say 270, your break even there is 167.30. That sounds right, right? So like, I kind of like the risk reward of those 170s. Now I could take a look and I could maybe do, if I'm targeting down to 155 guy, like I'm not going to sell a 155 put an August expiration at 57 cents. It's just like, that's just a waste of money. And I know what you're going to say. What would you rather do if you're buying a
leg into it?
I'd
rather leg into it, because you're obviously, by legging in, what you're saying is, I think I've caught this move. Today is a bit of a it's flashing a light on what potentially could happen technically. You just laid out the fundamentals. So if I believe that to be true, buying this put here makes a lot of sense. But directionally, if I start to be right, I can wait to sell the lower put, because I'm going to get paid more to do it if the stock begins to act in kind. So there are ways to do this. You put on a trade now because you don't want to be that clever, and I'm air quoting, or you could say, you know what, I think I got this thing. As it starts to move lower, those 155s that are now 57 cents are going to be worth maybe 85, 90 cents. And if I really catch it, maybe it'll trade up and double, maybe it'll go up to $1. So then the cost is more than mitigated in terms of the put that I bought. That's how I look at it.
Yeah. All right. So let's just look at this 175 strike. You see my cursor here? Okay. So let's just call them. They're 4.25 at 430. And I'm looking at the delta. The delta to me is basically the probability of this option being in the money on expiration, right? So if I were to pay 430 for these and 175 strike, I need a move down to 170, 170. Okay. And if you think, do the math, like it's at what, 3.5% or something like that. It's not like that far out of the money, in my opinion. That could be one reversal day. So are you a buyer of the 430, paying 430 for the 175 put, or you want to look at the 172.5 where you'd have a break even if you're paying 330 or 335 down there just below 170? What looks more interesting to you?
Yeah, I would go a little, I think I start to think about this and I'm like, you know what? I'm going to give myself a little bit of room, because if this starts to move the way I think it's going to move, it's going to accelerate. So I'm more inclined to do the 170s.
Okay, the 170s. Okay. All right.
That's
so
me. I'm not saying I'm right, but that's how my mind works.
No. So let's look at this 170. You need to move basically down 167.40 or something like that. All right, let's light that up. I think that that is so. It's 257 at 259 right now. So let's just make sure we're being diligent about 258. So it's coming in, it's coming our way, but that means the stock's going the opposite way. 257. So all right, 256. Maybe we get a nice round number, 250 guy. We just kind of wait and see if it's offered there. 255. Let's just pay 255. We'll move on. All right. So there's the guys like, let's not pick up pennies off of a freight train. So I like what's going on here, guy. We had that move to all-time high. You might call this this might be, what is the thing that you've called in NVIDIA a handful of times over the last 2 years? A chart.
You get these engulfing patterns that become very powerful. And we've seen them at least 3 times over the last couple of years. And today is setting up for the potential to be the 4th or 5th one. Given the RSI, given the news flow, this could be a very powerful indicator.
All right, you and I are long of the August 15th expiration 170 puts. We paid $255 for those. Okay, so we'll keep you guys up on that. All right, let's go back to what we're doing here. All right, earnings this week, guy, and we're going to hit more of this tomorrow with Katie. But we just thought the NVIDIA story was an interesting one. We wanted to take a look at Taiwan Semi. You see what's gone on there. We could have looked at Taiwan Semi in the same way, because a lot of obviously their customers are here. Let me just go over the legend here. Taiwan Semi makes what, 95% or so of the high-end GPUs. So this looks pretty similar, guy. I mean, it's just, is about as overbought. It's starting to roll over a little bit. You see that rising 200-day moving average about $200. I mean, could you see something back towards this gap fill in the 220 zone or whatever? So we'll keep an eye on Taiwan Semi, because they've already reported, they've given their guidance. Obviously, NVIDIA at the end of next month is going to be really important, but we're already there with NVIDIA. All right, this week.
Real quick. Okay, put up to this week, and while we're putting up this week, a couple things I just want to make sure people. So Lee J says, "You two scallywags," which is a great word. Have any thoughts on UPS? My God, what a disaster! We talked about that. Jake Grove, any thoughts on the real estate market? We addressed that vis-a-vis Whirlpool. And by the way, I think home builders now have a 10.8 months of inventory. I think that's the number that I saw, and that's the largest number we've seen in quite some time, which obviously suggests things are slowing there. So I'm not bullish on real estate.
Mm-hmm.
then Akira Suzuki talked about SoFi. We talked about that. So they're back to you. I just wanted to.
Well, we appreciate all the contributions, all the engagement. All right, let's pull this one up here. These are the main events. These are the 4 of the Mag 7 that we're reporting. We're going to do a bit more of these tomorrow, but I just wanted to highlight some of the implied moves here. Meta 5.5%, Microsoft about 4%. Those are tomorrow night after the close. Thursday, Apple and Amazon. For whatever reason, Apple and Amazon, I think, are probably 2 that are going to be on the back burner relative to some of these other bigger names. Apple, I want to take a look at, Guy, because this is one where, there's no shortage of negative news in around this. And a lot of it has to do with maybe their product offerings or the lack thereof. What are the super cycle upgrades going to look like for the handsets? It's going to be probably very evolutionary. The potential for them to lose this very high margin, exclusive payment from Google for search on Safari. Who knows what the remedies are. I just kind of drew up this chart here. Tell me what you see there.
Well, look, we obviously, like everything else, we cascaded into April. And if you go longer term, you'll see we actually traded down to the levels that the stock broke out from on that June day last summer. What they call it, that Apple Day or whatever the hell it was. Gene Munster, whatever. And Gene Munster said it was transformational. So that move made sense. But more importantly, and I think this is the overriding thing, the bounce has been feeble at best compared to some of its rivals in the Magnificent Seven or the Fateful Eight, as opposed to like a Microsoft or any of these other names. The move in Apple has been feeble. The moving averages have been sloping lower. We traded up to it, seemingly failed. There are significant, I believe, headwinds in Apple. So that's what I see.
Yeah, and so I just want to kind of detail an option strategy into the print. Let's go back to that other chart for a second here, the 1 year. And so you see that uptrend. To your point, Guy, it's gone from what, $170 up to where we are, 212. You can do the math. That's $40 on 170, right? It's a healthy sort of return. But look how much lower it is than its 52-week and all-time highs when you have a NASDAQ that just printed at an all-time high, an S&P that just printed at an all-time high. This speaks to, I think, a lot of the sort of fundamental headwinds. Now, from a technical perspective, you look at that downward sloping now, 200-day moving average. You look at that breakdown level. There's just really been no upward gusto. So as I think about the stock into the print, 3.5% implied move in either direction seems kind of muted. The quarter should be okay, Guy. Okay, think about this. They have this dollar weakness helps. They have a pull forward in demand, right, for their products in front of, tariffs and the like. It really is the back half of the year. What does momentum look like into a new product launch? What does basically demand look like in China, which has been really bad, right, in the midst of a trade war here, that sort of thing. So I look at this and I say to myself, if I'm long the stock, I might want to look to collar that. What is collaring? Collaring is basically taking your long stock position, selling an out of the money call, taking in that premium and using that premium to buy a downside put. Now, in this scenario, you have upside gains from where the stock is right now to the short call strike. You have downside losses to that long strike of the put, but you're protected below. So why would you do this? You would do this if you're worried into an event like this where you want to hedge, you want to basically, parameterize what your losses to the downside, but the trade-off there is that you're capping your potential gains because you're using that premium. So one strategy that people do is they just buy puts. I don't love that strategy. Okay. You do that too frequently, it's going to be a real drag on your performance. But if you think about a collar into an event, it makes some sense. Also, puts into events are going to get pumped up, right? So oftentimes in names like this, calls can too. So you're going to use that premium pump into event. So let me just give you an example here, Guy, and we can walk through this and if you like the levels and the like. Okay. So if I have a 3.5% implied move, I'm basically saying $10 in either direction. Let's just, do the math. All right. So I'm going to look at August expiration, and with the stock trading at about $212, $212.50, let's call it. Okay. I'm going to look at the 202 half put strike versus the 222 half call strike. So I'm selling one of the calls at $2.25 about, and I'm buying one of the puts for about $2.25, which makes sense. $10 out of the money, $10, out of the money, that sort of thing. Here it is. So I have profits up to 222 half. I have losses down to 202 half. I'm protected below. I'm capped above. This is just kind of a set it and forget it, sort of like into an event. I like the risk reward here. the likelihood of this stock, in my opinion, Guy, being up 4, 5, 6% or something is not particularly great, given the way the market is working with names that are not doing big beats and big
and look, and if you get called away, if in fact it were to sort of gap higher and you get called away, it's not the end of the world, number one, because this strategy here is to sort of give you peace of mind into an event. Get called away. Okay, you know what? Let's see how it plays out. Give myself a couple days. Can always get back in the underlying stock. If it goes nowhere, at least I protected myself a little bit. Worst case scenario or best case scenario is the stock cascades lower, and then you say, you know what? I protected myself in a really clever way. So this is the peace of mind trade for you Boston fans out there.
Yeah, there you go. Really quickly, let me go back to the legend and just kind of show the options chain here, because I'm going to August 15th expiration. You see where I am right there. Double check that. I'm going to press down here, brings me to the money, at the money here. And so the stock has come in a little bit, and we were using those. But like, if for instance, let's just kind of look at the 220. Okay, that is 277 bid, right? That is the 220 call. And then I want to look down here and I want to say to myself, okay, what can I get on the put side for that 277, right? And I can look at, okay, well, here's the 205 that's offered at 320, but let's go to that 202 strike. So I'm basically taking in a little bit of a credit. And so if I was doing that against, let's say 100 shares long, I would look to trade one option against that. All right, we did that, Guy.
I think we've laid out a couple of really interesting trades on this Tuesday, not Wednesday, not Butter's Day. Tomorrow's Butter's Day. You mentioned Katie's going to be with us. That'll be fun. I know that I have to leave because in a couple hours, we're sitting down with Phil Snow, the CEO, the long-standing CEO of FactSet. That's going to be a fun conversation because Phil's been there his entire career. So I look forward to that.
28 years he's been at FactSet. He started out on the helpline and he ended up as the CEO guy for the last, 10 years ago. Great dude. We've really gotten, enjoyed getting to know him over the last 5 years. They've been one of our great partners, I think since the beginning of Risk Reversal Media. So that's going to drop in the Risk Reversal podcast feed on Thursday morning. Katie Stockton tomorrow on the Risk Reversal podcast. Peter Bookvar is in the Risk Reversal podcast feed right now. So go check that out. We had a great conversation. It was a preview of the Fed. That's tomorrow. Check you later. We'll see you tomorrow, 11 a.m.